Risk management. One of those things you hear about all the time, but oddly enough, never pay really much attention to it. That is, until now. What if I told you all you had to do was apply one simple tweak to your current strategy that would instantly boost your trading profit? Like, actually, implementing this trick on any trading strategy has been statistically proven to generate better profits. Once you apply this tweak, your take profits will grow, your risk will shrink, and it'll take you from this average looking setup to this sniper looking entry with jaw-dropping profits.
But what's the secret trick?
Well, first things first, we need to go on a chart. Go to the 4-hour time frame. This is important. Next, we first need to implement our areas of supply and our areas of demand. If you don't know, demand is the start of a strong move upwards, supply is the start of a strong move downward. For example, if we had this move where there was a strong impulse to the upside, we would find the candle that started this move. So this one. Grab our little rectangle tool on the side and mark from the lower wick to the higher wick of the candle that started this move. This is our area of demand. Pretty easy, right? This area is where large institutional orders started coming in. Oftentimes, price will come back down to this area of demand. Traders will then proceed to have the exact same mindset, enter here, and then proceed to make some juicy profits. It's the exact same thing with supply. Find the start of a strong move downwards, grab your little rectangle tool, mark from the lower wick to the higher wick of the candle that started that move. Wait for price to come back up to the area of supply again, enter a short, proceed to make millions of dollars. But we ran into a major problem. So if we're purely going off the whole supply and demand strategy, we might get a setup that looks like this, where we have the start of a strong move upwards, we mark our area of demand by marking the first candle of said move, we would then wait for price to come back down to our area of demand. Now, if we're entering into this position normally, we would enter as soon as price entered into our area of demand. We would set our stop loss below the area of demand, and for our take profit, it would really only make sense for us to target the recent highs for the most probable outcome. But this is exactly where the problem resides. This risk reward setup is absolute poop, like really poop. To be a bit more specific, this exact trade had a 2.14 risk to reward ratio, meaning if we're risking $100, we are only potentially getting back $214, which may not sound bad to some. Hell, if you use this exact same strategy, you would probably still be profitable. But with that said, what if somehow, some way, we could raise this risk to reward number to where we would still be following the exact same strategy, but we would be risking even less and profiting even more? That would be pretty good, right? Actually, I just got an idea. Let's test out this new Siri-based audio editing software I just got. Hey Siri, play classical music.
Sorry, I didn't quite get that.
Can you play some classical music?
Sure, playing rock music now.
Rock? No. Siri, stop. Play classical music.
Did you say how to double your money?
How to double my money? What? That doesn't even sound similar to what I... Yes, you heard her right. You can double your money.
How do I do that?
Well, there's a Forex broker out there that I personally use, and their name is HankerTrade. If you use the link in my description and it's your first time depositing, they will match whatever you first deposit. So say if you first deposit $69, they will match that and give you $69.
That's pretty cool.
If you need a new Forex broker and want that deposit bonus, use the link in my description. All right. Now let's go over how to get a better risk to reward. To do this, we're gonna go over a little topic called zone refinement. Zone refinement is pretty simple actually. For example, here we have two screenshots of the exact same chart, one on the 4-hour time frame and one on the 1-hour time frame. Just like before, we have the start of a strong move upwards, so we'll mark our area of demand on the 4-hour time frame just like we did before. But instead of entering as soon as price hits our area of demand on the 4-hour time frame, we're gonna move to a smaller time frame to refine our zone even more. So here on the 1-hour time frame, our 4-hour zone is right here. But if we look closely, our 1-hour demand zone is within the zone, but is much smaller. So we'll mark out this one too. So now we have a refined 1-hour zone within our 4-hour zone. Instead of entering as soon as price hits our demand zone on the 4-hour time frame, we're gonna enter at a refined zone on the 1-hour time frame. So we wait for price to come to our 1 hour zone, enter here. We're still gonna set our stop loss below the 1 hour demand zone and set our take profit at the recent highs, just like we did before, but look at the key differences. The picture on the left, where we didn't refine our entry, our stop loss is bigger, our entry is worse, and our take profit is smaller, and we have a risk to reward of 5.15. But if you look at the picture on the right, we have a way better entry, our stop loss is smaller, meaning we're risking less, and our take profit is bigger, meaning we have the potential to make more money. And we have a risk to reward of 11.12. Both are using the exact same strategy, but one is just more redefined. I think you can see the obvious better choice, the one where the math is on our side. But this is just the idea. Let's jump into an actual trade example. First things first, we do our first step and hop on the 4 hour time frame. Here we have a pretty strong downtrend, but price is starting to show signs that it wants to do a reversal. How I can tell it wants to reverse is it just started to shift in trend direction and has made a break of structure right here. So we'll keep that in mind. To start us off with this trade setup, we're gonna first mark our area of demand. To do this, we find the first candle that started the strong move to the upside. In this scenario, that would be this candle right here. So we grab our little rectangle tool on the left and mark from the lower wick to the higher wick of this candle. This is our demand zone. So if we were to plan this trade out normally, we would wait for price to come to our area of demand. We would enter as soon as it does and set our stop loss right below it. We would then target the most recent high, which is this high right here. So if we use these exact parameters, our risk to reward would be 5.23, which in the end isn't really a bad trade at all. Hell, I'd take a 5.23 risk to reward all day. That's actually pretty good. But as my grandma used to say, why settle for a low risk to reward when you can get a better one? To do this, we're gonna switch to the 1 hour time frame to refine our demand zone even more. So now that we're on the 1 hour, we can instantly see we have more candles now. We still have the exact same setup, just more candles in our view. Our 4 hour demand zone is still here, but if we look closely, our 1 hour demand zone would actually be right here at the candle that started this trend. So by doing this one simple trick, this one simple change, we can do what every hedge fund manager dreams of doing. We can do this. Now look, this may not seem like much, but we improved our risk to reward ratio from just a measly 5.23 to a whopping 7.6 by simply dropping to a lower time frame and refining our zones. That's it. That quick and simple easy trick just improved our risk to reward by 2.4, meaning we're risking less now and we have the potential to gain even more money. And who doesn't want more money? So now that we have it set up, we're gonna go to the 4 hour time frame, and rather of entering up here at this high, we're now entering at a more discounted price in a refined area, which is gonna give us the best risk to reward for this trade. Let's see what happens. Price comes down to a refined zone. We enter as soon as it does. The market proceeds to push up with huge amounts of strain and beautifully hits our target. But even though this strategy is great, we've ran into a major problem. You see, I'm sure you've had this thought already. Well, if I can get a better entry from going to the 4 hour to the 1 hour, that also means I can get an even better entry from going into the 1 hour to the 30 minute, then the 30 to the 15, then the 5, and then continuously go all the way down to the very millisecond. And that, my friends, is what I'm gonna call over refinement. Over refinement is a problem simply because of this reason. Say if we went to the 5-minute time frame for this specific trade, we would have to zoom all the way down to this 5-minute demand candle. And the problem with that is, sure, we now have an amazing risk to reward and an even better one than we did before. But since we've narrowed it down so much, if we zoom back out, price never came down to our 5-minute demand zone. Don't over refine and don't zoom in too much, because you'll end up with missed positions just like this one. To make sure you don't over refine, just follow what I call the 2 steps down rule. So if you're on the daily time frame, you can only refine down to the 4 hour and then the 1 hour time frame. If you're on the 4 4 hour to start out with, you can only go down to the 1 hour and then the 30 minute. If you're starting off with the 30-minute time frame, you can go down to the 15-minute and then the 5-minute. My point being, you can only go down 2 steps from the original time frame you started on. This will make it so you don't over refine and end up with a missed position. Add this trick to your arsenal to any of your trading strategies and it'll help you get more sniper entries. Try it out, let me know how it works for you, and DM me on Instagram with your results. Thanks for watching, and I'll see you guys next time. Also, I've been getting a lot of comments saying I need to post more, and you're probably right. I'm kind of slacking recently. I'll try to do better. Maybe. We'll see.